There's an old saying in the market, the trend is your friend. It's been updated to say the trend is your friend until it isn't anymore. Now, one has to understand trends no matter how you're going to trade, no matter what strategy you're going to trade, no matter what asset you're going to trade. Now, keep in mind, some people confuse trends and trend lines. Trend lines are a tool that we place on our charts to analyze or set up our support or resistance and analyze the movement of the asset. Trend lines are a rule-based tool. So it must follow very specific rules. Trends, on the other hand, are not. Trends are analysis of the crowd behavior of an asset. So we have uptrends, we have downtrends. We also have sideways trends, congestion. Most of the time, the market moves in total congested mess. An uptrend means the market is moving up. A downtrend, of course, means the market's moving down. But this trend could be, an uptrend could be that way. In fact, we're going to look at one that's that way. Or it can be this way, or it could be steeper. The quality of the trend helps you understand the quality and the potential of the trade you're about to make. The more well-developed the trend, the more clean it is, the more likely you're going to make a high probability trade. Now, my strongest belief is that the markets at all times are totally random. They go all over the place because we have millions of human beings making millions of decisions all over the place. But there are certain times that the markets start exhibiting non-random behavior. This non-random behavior is what a trend is. When the markets start moving in this non-random behavior, we can understand it, and then we can make intelligent decisions. So we must first be aware of the trend. Without identifying trend, we would be gambling. And that's not the purpose of forex. We're not going to look and say, look at that. I think it's going to go up. I'm going to waste some money. I think it's going to go down. I'm going to waste some more money. This isn't Las Vegas where you're walking past the roulette table throwing the chips on the table and hoping 00 comes up. Okay. Trading is all about finding high probability potential trades. So what we want to do is, number one, observe. Now, the rule of thumb with a trend is an uptrend is a series of higher highs and higher lows. Push, ease, push, ease, push, ease, push, ease, push, ease. Now, again, like I said, it can be steeper or it can be flatter, but it's a well-developed trend when you can see the higher high, the higher low. So in other words, each time the market surges and pushes, that new high it reaches before it eases back down to make its retracement should be higher than the previous high. The low it touches when it's easing back down should be higher than the previous low, and then pushes against to make a new high, eases back down to make a new. Now, to explain this in an easy manner is, you have traders all sitting out here, and you have an asset, doing all kinds, whatever the asset wants to do at the moment. For some reason, we have no idea what the reason is. Believe me, if we can figure out the reasons and know what they are, we could always, get in the markets early and be millionaires overnight. We don't know. Okay. But for some reason, and it's usually by institutionals, that something starts pushing that asset up. And we won't notice that. We won't realize it. We won't realize it's even an actual movement. It will start to move up or down, whichever the case may be. One thing, down always mirrors up. Okay. So as the asset starts moving up, now remember, institutional buys and big buys from high-end professionals always have a not only exit strategy, they always have a target point where they're leaving the markets. Okay. They don't sit there and count the pennies. They say, okay, I'm going to buy the euro at 108 and I'm going to get out at 108.10. Okay. They're trading millions of dollars. They get 10 or 20 points in their favor. They made their money for the day. Now, we don't know what they're setting them out. We have no privy to what they're doing. All we can see is on our charts, the price starts moving up. But just because it moved up doesn't mean we have a trend. Doesn't mean anything's going to happen. Doesn't mean it's just going to go to here and not come down to here. But at some point, this movement starts to get some energy into it. Okay. Now, we're all sitting over here on the sidelines just watching because none of our indicators, none of our oscillators, none of our information tells us anything. Now, what happens is at this point, other big professionals, banks, people trading huge accounts, not us, not the retail traders like us, don't see anything. Okay. But those other traders the big traders are coming in the market, and that movement is starting to gain some energy. Okay. So some of us who are more astute might start also jumping in the market at this time and pushing that price up. Now, at some point, that price hits the level that those first institutionals set up their cells, a long time ago. So what happens is there's a sell-off at this point. It's hit a point wherever it is. Doesn't mean it's reversing. Doesn't mean it's turning down. Doesn't mean it. Now, also, these smart guys sitting on this over here said, when it hit this price, that price is a little bit too high. I should have gotten in here or here, but this price is too high. So they're all on the sideline. As the price and the asset sells off and it clears out all the sell orders, the price comes down to a new point. These smart guys here say, that price is low enough. I'm going to jump in the market and buy. And what happens is it starts pushing that price back up. Now, what happened is, see, we made a higher high, a higher low from where it started, and now we've gained a new higher high. Okay. And each time that this happens is because the price has gotten a little bit too high, and a lot of the buyers are just moving on the sideline. But if we understand that in order to do this requires a great deal of energy, this is where we have to start coming in and understanding. Once the market starts doing this in a well-developed trend, because we have upward movements, downward movements, we have unqualified trends, we have all kinds, but when we can see a qualified, well-developed trend, we know it's taken a lot of momentum and there's a lot of energy inside this push. It's not going to, it's not that it can't, but it's not just go to here and then come down. Can, but it's highly unlikely. We will see, using indicators and our eyes and price action, reading price action, when the energy starts coming out of that movement, when it starts losing its speed. Okay. But we don't need to get in here. We don't need to get in here. We don't need to get in here. We, as trend traders, only want to get in when we have a well-developed trend that we can say, okay, there's enough energy in that market, in that movement, that, yeah, you may not get it this far in. You may not make a huge amount of money or profit, but we know that the market's got enough energy that even it's going to slow down, I'll be able to see it, but I'll be able to make some profit. Okay. Because we don't want to be the first win and we don't want to be the last out. We just want to take our little sliver of the pie and be happy. So trends like this downtrend happen all the time. And how do we see it? Now, there's all kinds of people that use all kinds of technical indicators and trend indicators to tell them something's happened. The only best way to do it, the only successful way, is through observation. You want to look for this stepping pattern in the asset movement. So hold on one second. Let me pop up some live charts here. Okay. Now, here is just it's not a random size chart that I teach from regularly, but it's AMC Holdings. What do we have? We have currently, this is a live chart, and we have a pretty nice developed trend, downtrend. We have a series of higher highs, higher lows, higher high, higher low, higher high, higher low. And it's developed pretty nicely. So this happens quite often. Here's the euro today. Now, look at this movement. The euro, no, 2 days ago, bottomed out here at 108 and then turned around and started moving up. We wouldn't be able to see this uptrend. We would have thought it was a recovery off this fall down here. But look at that. We can see when the energy actually started coming back into the marketplace. We see the push, the ease, a push, ease, push, ease, push, ease. Every time making a higher high, a higher low, a higher high, higher low, higher high, higher low. Moving straight up until we got this huge push today. I don't know what pushed today. I've been watching the markets that much, but something gave it a huge surge today. And even though it remained in this upward movement, it kind of really changed the speed. So we can then see a push, ease, push, ease. Now, if we would have seen this movement here, we could have entered the market somewhere around here. Now, if we were, most of us wouldn't have stayed in past this point. But if we would have gotten out at this point, as soon as it started moving the sideways range, we would have made ourselves some nice little profit. Okay. And this is just through observation of the markets. It's understanding the trend and how a trend moves and understanding where the energy is in the market. Now, someone once told me, and I don't remember this a long time ago, and I use it in a lot of classes, and I should look it up again. But an old-fashioned locomotive moving on the train tracks, it takes off from the platform. And remember in the old cowboy western movies, you'd see it chugging along. You'd see the steam coming out. The guys would be throwing the logs and the coal into the burner, and the train would go chug, 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 chug. Well, that's the beginning of a trend. At some point, those wheels start turning faster and faster where the train is almost moving effortlessly. Now, when they come up to a bend, if they haven't pulled on the handbrake way before that bend and start slowing down that train, they're going to go off the tracks. And somebody once told me that a locomotive traveling at 60 miles an hour actually requires 8 miles to stop. They're going to stop without, jerking around to come to a complete stop. Now, that's the same as you can imagine in a trend. A trend, somebody can jerk on the handbrake, throw it off the tracks and fall over and get it to stop. But most likely that conductor's going to slowly ease that brake on. Maybe if he's got some warning something's happening, but may put it on a little bit faster. We don't know. In the markets, we don't know. Now, we can use indicators to tell us when the market is losing speed or it's losing momentum, or when it's about to change in a direction. Okay. And it depends on how adventurous of a trader you are. Like I said, I don't want to necessarily be in the market when that conductor's putting on the handbrakes. I would like to get out while that train's still traveling at full speed. I'd like to enter when it started going chuck, 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 and get out before I hear the squeal of the tracks. But finding the trend is tricky, especially for beginning traders, and most traders will find that this is a sticking point in their trading development. It's okay to understand various entry triggers and setups, but if you're trading against a dominant market bias, your probabilities of making money decrease dramatically. In other words, don't try to trade against a trend. There's always a bias, and as a beginning trader especially, you would be well served to stick with it. Okay? So there always is a movement bias, like I said. Price can be moving up, and so we can say there's a bias to being moved up, but it could be moving like this. It could be moving like we saw with the euro today. Okay. But we're looking for the quality of that movement. Because when the quality is good, the better the quality is, the less random that movement is, and the more we can interpret. And believe me, it happens on many, many assets all day, every day. These are not esoterical things you're not going to find. I guarantee you right now, if I went through 10 charts, I'd find 4 or 5 nicely developed trends. And they develop, you can, because of our type of trading, we're trading in short-term trade, they develop just as nicely in 15-minute charts as they do in 1 hour or 4-hour charts. Now, for us, we can only trade in that short-term window because we're trading in fast trades. But I don't use a 5-minute or a 15-minute chart to determine my trade. I use a 5-minute or 15-minute chart to develop my entry point. But I'm looking at a 1-hour trend chart at least to make my decision as to whether I want to buy or sell something. Once I've made my decision whether I want to buy or sell, I have to figure out what price I'm willing to enter the market at and how much money I'm willing to risk, as well as where I would have to put my stop losses and what my risk reward ratio is. That I do in 15-minute and 5-minute charts. But I make my determination as to whether I want to buy an asset or sell an asset at that time in today's market by looking at my trends on the 1-hour chart. So the trend that we seek to trade is different from random fluctuations. Range patterns and similar price movements in that the price itself is the absence of any technical indicator. We can still be recognized as showing a trend. Okay. There are all other types of strategies. This is trading with a trend. You can have reversal trade setups. You can have short trades. You can have all different types of strategies and setups. Today, we're only talking about not trading with a trend line. We're talking about trend trading, which is a whole category of trading on its own. So in other words, there is some driving conviction behind the price action, which allows the trader to easily identify it visually. Depending on the type of trend, that's up or down, Successive highs and lows should constitute the rising or falling pattern with relatively few irregularities. But such a case is often a rarity, and traders will have to back his technical patterns with conviction that can perhaps only be gained with sometimes fundamental analysis. So if the trend can be identified visually, why use technical tools? So even though we can notice the existence of a trend, we still need technical tools to trade it and to time it. Okay. Because like I said, I use my 1 hour, I want to see that well-developed trend in my 1 hour chart. Okay. Fine. Then I make a decision. I'm going to buy the euro. Okay. I'm not buying it this second. I'm going to look at buying the euro. Okay. Now I'm going to squeeze my charts down. I'm going to look at my other tools and determine at what price I'm willing to buy the euro, where I'd have to put my stop loss, where I'd put my take profit, and then determine if I'm going to execute a trade. So remember that a good qualified trend has push and ease. The ease are retracements. They shouldn't be points of panic. But when you're looking to buy or sell into an uptrend or downtrend, you should be looking to buy or sell at the, you're never going to find where that retracement's going to flip around and start moving up. Never, never, ever, never. That's like trying to catch a falling knife. When you see that retracement start to push above the previous high, that's the point that you want to get ready to buy. So often a market will retrace to approximately the level of its previous swing points before the trend resumes. And we have things like, so we have support and resistance lines, we have Fibonacci, all kinds of things to try to help us calculate these retracements. If you're trend trading, you can see them. Okay. It's more important to calculate them if you're in the market that maybe it's retracing too low and you want to get out of the market. But market timing is a difficult thing to get. Market timing never works when it's trying to predict reversal points on a technical basis. However, market timing in the context of a trend with the purpose of picking the counter trend extremes and using them to enter a trade is necessary and advantageous. And there lies the main principle of trend following strategy. Recognize the trend, identify the counter trend move, which is the retracement, and use them to enter in the direction of the trend. Now, you can also do market analysis by using tools like MACD, which help us see moving average convergence and divergence, will help us define our entry points. Okay. You can use all types of other tools. Okay. But in a nice moving chart, you can find a lot of well-developed trends and a lot of easy, high probability trades. Okay. Now, how do you put your stop loss and take profits when you're just trend trading? Well, this partly depends on the term and the nature of your trend following method. A stop loss order can be placed a short distance above or below the trend line, whether it's provided by a moving average or a simple line drawn on a chart. In our opinion, the trend follower should never realize his potential until he has a good reason to do so. In other words, you can set your targets because you have to set your target in order to calculate your risk reward ratio. But as long as the asset is moving in that well-developed trend and holding on to that momentum and moving at the same overall speed, you should never close your trade. Just let it keep going. Sometimes an asset can trend for a very, very long time. Now, there are key things we want to look at because an asset can move this way and then start slowing down, but that doesn't mean it's going to reverse. Okay. One of the key things we should always be looking at is volume. Volume will help you know if there's a problem with the markets. And then certain momentum indicators, because you want to know when the market is starting to lose its momentum. And MACD will help you see that the momentum is coming out of the market. So in other words, you shoot a firework up into the sky. It's going to go up and up and up and up. Now, if we were a scientist, we could calculate based on the gunpowder and the velocity and everything when it should start easing back down and fall to earth. But we shoot it up there and it's a hot day and the sun just came out from behind the clouds and it's heating the everything up. And so what's happening is, and then the rocket you shut up there gets into a strong drift of air that's warm, and it allows it to continue flying, rising farther before it turns to come back down. This is not a finite point. If an asset starts losing momentum, it can continue going up while it is slow, while that momentum slowed down or the speed slowed down. We don't know exactly when it's going to flip over and come back down to earth. Okay. So I, for one, the minute I see the momentum coming out of the market, I want to exit my trade. So trend trading, or this method involves a risk management strategy. You need to be able to see your risk, use it properly. Changes in price may lead to a gradual reduction or increase in the initial trade. On the other hand, adverse price movements may lead to an exit of the entire trade. Whenever the trend starts changing its velocity, when volume stops supporting the movement, when it comes to a major line of resistance, you always have the choice to exit the market. So the first one we always need to look at is price. One of the first rules of trend following is that the price is the main concern. Traders may use other indicators showing where the price may go next or what it should be doing as a general rule. A trader needs only to be worried about what the market is doing, not what it might do. The current price and only the price tells you what the market is doing. Always use proper money management skills. Another decisive factor for trend following is not the timing of the trade or the indicator, but rather the decision of how much to trade over the course of the trend. Always use proper risk management and cut the losses if anything doesn't go in your favor. If nothing, don't hold your breath and say, I'm going to stay in there, it's going to ride. Okay. If the asset doesn't do what you expected it to do, take your small loss and get out of the markets. So remember, trend following should be systematic. Price and time are always pivotal. The technique is not based on the analysis of fundamental supply and demand factors. Set up the conditions, enter the rule, use entry rules, set up your initial stops, and have exit strategies. So there's an old saying, the trend is your friend until it ends. So in the investment universe, trading a trend following system on a single market or only a few different markets is suicidal. Only because you get bored silly and you'll never get a trade in. This offers you a lot of ways because what you're looking for now is not the asset. You don't need to delve in the asset. What you're looking for is a specific thing happening on a price chart. So there may be long periods when nothing is actually trending. And if you're using only looking at a short range of assets, just because price is going up or down doesn't mean it's trending. So the key idea is that you can trade many different markets because what you're looking for is a specific set of things happening in a chart. So the investment universe will have a much greater impact than tweaking buy and sell rules. So choose widely. Trends develop for a reason, perhaps due to a shift in economy's fundamentals. Trends show a bias that has existed on the charts. While the future is opaque and unpredictable, the bias may continue. But that's why so many traders look to trade trends. After all, the future is unknown, and nobody has a crystal ball that will magically foretell tomorrow's price movement. But the fact of the matter is that biases do exist. Trends do take place, and in many cases, those trends may continue. So there's many types of strategies you can use for trend trading. Your strategies are endless. What you're going to use to adjust, what you're going to use to enter the market, how you're going to exit the market. But it is often possible to improve the returns of a trend following strategy by adjusting the face value of the trades according to the volatility of the underlying market. Generally, by reducing the face value at times of high volatility, the information ratio is improved. In other words, during high volatility, you may want to limit your trades. During low volatility, maybe make more. But remember, find your strategy, own it, keep it simple, and just get it done. You don't have to overcomplicate your decisions. You know, somebody once said it to me a long time ago, and I use this in class also. When you're sitting, when you don't have a trade open, you're just sitting on the sidelines. You're a spectator. You're the guy at the soccer stadium rooting on for his team, but you're not the guy on the ground playing. You're not making any plays. You're just yelling up there, yelling, booing, hissing, doing whatever you want to do. Picking up every fault your team did, but you're on the sidelines. When you enter the trade, you've now entered the great game. But the fact is, entering a trade is the only time you take on risk. So you went from sitting on the sidelines where you were safe and doing all this booing and hissing and clapping and screaming and supporting to the next step of taking on risk. Okay. And that puts you in the game because the minute you take risk on your plate, you're actually in this game. But you have no profit. You can't make profit while you're in the game. Can't make profit sitting on the sidelines. Can't make profit when you enter the game. The only time you ever make profit is when you exit a trade. That's the only time you have profit that goes into your account. So exiting a trade is probably the most important thing you can set up and figure out. So you go from sitting on the sidelines being a spectator to taking on risk. You need to know what you're going to do and how you're going to enter, how you're going to behave so that you can get out of that market and take profit with you. So figure out how you're going to do this. Don't make it overcomplicated. Deciding they're going to go from the spectator into the player doesn't take much. You don't need to overcomplicate it. You just need to get in that game. Being more important is how to protect yourself in that trade, manage your risk, and how to get out of that market with your profit. So on that note, thank you very much for supporting Albexo. Have a great trading week. I hope all of you, no matter what you follow, what your traditions are, you had a great holiday or are having a great holiday. And we'll see you again next week. Bye now.